In our studios with us today, we have Melissa Delana, and she is an attorney. She's a real estate attorney specializing in only real estate, and she is a partner in Delana Law Office, LTD, right out of East Greenwich, right? Centralized right in the middle of the state.
That's correct.
And Melissa, thanks for being a part of the show today. We've got a really great topic.
Yes, today's topic is a very hot issue that all sellers should be aware of. We are talking about capital gains and the Rhode Island non-resident withholding tax of 6% that out-of-state sellers have to be aware of.
Mm-hmm. It's huge. It hits people sometimes, and they're not even aware of it. Sometimes, well, I got a story to tell. I'll tell you after.
Absolutely. We are the only state, as far as I know, that imposes a non-resident withholding tax. And we actually have taken that from the federal government because there's a federal non-resident withholding tax. So any non-U.S. person or citizen would be subject now to a 15% foreign person tax.
Wow.
So that is something that we don't see as frequently, but I believe that the Rhode Island government kind of borrowed that theory and has imposed the non-resident withholding tax on non-residents or non-Rhode Islanders at the time of their sale. And it's something that many sellers are not aware of, and only at the time of the closing, when they provide me with an out-of-state driver's license, do they learn of this very unfortunate tax.
Yeah, your real estate agent should be educating you on that from the get-go. You know.
It is also recited in the body of the sales agreement that non-residents are subject to that tax, but unfortunately I feel that a lot of folks just are not aware of it.
Overlooked.
They're not reading the sales agreement, so they're not prepared. There are ways to minimize and avoid the tax, but it does take awareness, and then it takes some preventative measures.
Yeah, absolutely. So can we talk about the different ways to minimize the tax?
Absolutely. So, and the other issue that we're talking about is capital gains. So they really do kind of go hand in hand. So in Rhode Island, if you are not a Rhode Islander and you're selling, you have to be prepared for the 6%. And the way it would work is that if you showed up to a closing, the closing attorney would have to take 6% of your bottom line and remit that to the State Division of Taxation. So if you have spent the time ahead of the closing preparing for this, we can actually file, as real estate attorneys, and accountants can file it as well, a non-resident withholding return that is filed with the Division of Taxation in advance of the closing.
Okay.
And this actually allows the state to determine what the actual gain is, if anything, that the client is facing. And then they're only charged 6% based on the gain, not on the overall bottom line that they're making.
So our listeners are probably asking the same question as when I first learned about this years ago. What I asked. Now, what are some of these deductions that you could use?
So ultimately, you need to know what your basis is in a property. That's the difference between your sales price, net of all the expenses, and your tax basis or your investment into the property is what is truly taxable at that 6%. And incidentally, that's the same number that would be taxable for capital gains purposes.
Oh, okay. All right, great. So basically, let's just say if the house was selling for $300 and they bought it for $150. Well, that's $150, boom, gone right off the bat. Now, let's say they put in a $100,000 addition on the house.
Yes.
That's another $100,000 gone. So now they're only susceptible to $50,000. However, I do believe that capital gains. The 6% withholding only starts. The capital gains only starts after $75,000 or more is profit, right?
Capital gains would be subject to any type of real estate that is not a primary residence would be subject to capital gains. If there's any floors, I am personally not aware of it. That really becomes more of a CPA or an accounting question.
Okay.
So I would certainly defer and always defer my clients back to an accountant as to whether or not the first $75,000 is tax-free. I'm not aware of that for capital gains purposes, but that very well may be the case.
Yeah, but the point though that we're really trying to drive home here is that when you're listing your home for sale, you want to make sure that even before you do so, you're collecting the right information, because especially if it's a second home, okay? Instead of having to pay all these taxes to Uncle Sam, look, we pay enough taxes. Instead of having to pay extra taxes or more taxes, let's make sure that you're set up to win, okay? We want to make sure that you have that nest egg to retire with. I'm sure that you would, later on down the road, like to leave something to the grandkids, even if it's $20,000, $30,000, $40,000, okay? Or you might want to take a vacation, take a cruise around the world. There's a lot you can do with that extra money. Okay, so this is very, very important. That's why I refer my clients to, attorneys like Melissa Delana who can help them out and guide them through that process before they hit the closing table and have to sign on the dotted line where now they're owing thousands and thousands of dollars.
Absolutely. The non-resident is something that comes up at the table. Capital gains, though, is not something that's actually collected at the time of closing. So if clients aren't prepared for it and haven't been considering it and aren't talking to their tax professionals about it, they can really be blindsided at the time of their tax reporting year. Oh, wow, I didn't realize I had all these capital gains. So that's why we like to talk about it at the time of listing, at the time of sale, so that they can anticipate if there are going to be capital gains, what that financial outlay will look like, how they can prepare for it with their accountant, what other types of countermeasures they can take to the extent that that is something that is available to them. So there's a lot of planning that goes into any kind of tax preparedness. And that's why talking to an attorney, talking to an accountant is a really important exercise if you're not selling a primary residence. A question that I get a lot, Emilio, is how far in advance does the non-resident withholding filing have to be reported to the state?
That's a good question.
And the rule on the website is 20 days. But that is assuming that you're mailing in the forms. I personally don't trust the mail when it comes down to that kind of thing. So our office has always had a industry standard where we personally file it with the Division of Taxation.
Wow.
So we can take care of getting the filing done right up until the day of closing, because sometimes people aren't thinking about this in advance. So it's really never too late until the closing. Then it's too late.
Yeah, no, that's good to know. And here's one of the reasons why we were kind of inspired to do this segment, as most of our segments, is real world experience. We recently ran into a client of mine, my team's, that lives in Florida and has a home to sell here. They just changed their license over and their residency over before they listed their home here in Rhode Island to sell. So we're going to try to figure out exactly how we can obviously fully legally and ethically get them the lowest tax payment as possible. And it may not even make sense for them to list, by the time we're done our research, or maybe it will. I don't know, but we're going to dig down and find this information. So, you're better off getting all that information up front. I know that while my client was not so happy about that, he was happy that I educated him on this now.
Absolutely.
And I connected him right with Melissa, and Melissa's working with him.
And this happens so frequently,
all the time,
especially with snowbirds.
Yes.
People who go out of state because there's tax advantages. You can avoid personal property taxes for your car if you register the car out of state. So people often don't realize the implications that they will have as a function of changing their driver's license prior to a closing, just because they're trying to avoid other taxes. I mean, usually that's the big motivator. The
government's going to hit you one way or another. They got this thing down to a science. They have two things we don't have, guys. It's time and money. It seems like they have unlimited amounts of our money to spend. So anyways, that was a great segment. Thank you so much, Melissa. If you'd like to see this video, give us till about Tuesday or Wednesday, and it'll be on the roundtableradio.com. Okay, the roundtableradio.com. You can check it out. And again, Melissa Delana with Delana Law Offices, thank you so much for being a part of this.
Thank you for having me.